Hello traders, I am really happy to show you a little bit of a snippet of the Polymarket trading course. You are about to see module 3 of the 25 module 25 video course I made on Polymarket. This includes everything from being able to buy very cheap teams on live sports games in order to 20x, 100x your money, from copying smart money, from knowing how to set unexploitable limit orders, all stuff like that I talk about in the course. So enjoy this free snippet, and if you're curious about the other 24, I highly recommend checking out the course in the link in the description below so that you can beat Polymarket and learn how to consistently make money. Happy trading and enjoy module 3. And welcome to the third module, GTO, also known as Game Theory Optimal. Let's dive right in. What is game theory? How does it apply to Polymarket? Well, first of all, game theory is going to be just about everything when it comes to prediction markets and when it comes to Polymarket. So these are the topics we're going to be covering before we go forward. As you can see, I'm not going to read off all of these because we're going to be detailing all of them, but this is what we have ahead of us. Let us start off with games. What are positive sum, negative sum, and zero sum games, and some good examples of them as well. Positive sum games. These are cooperative scenarios where actions benefit multiple participants simultaneously, increasing total value or payoffs. A very easy example of this, guys, imagine that we have a town that relies on its farming. You farming and your neighbors all farming together, let's say, to grow crop for the entire town is a positive sum game. By other people farming, guess what? Your family gets more food. It's great. And by you farming, you get more food and other families get more food. This is a positive sum game, okay? Now, let's talk about negative sum games. These are games where the total combined outcomes are negative and players will collectively lose value. A good example of this would be two traders on a futures exchange, both trading, let's say, high leverage. So let's say that two traders, one uses a limit order and the other uses a market order, and they trade against each other. But both of them are on high leverage and with high fees, and unfortunately for them, the contract is Bitcoin. It goes up and then it goes down and it liquidates both. That would be a negative sum game. A zero-sum game. One player's gain directly corresponds to another player's loss. The total payoff is going to always be 0. Guys, Polymarket is a zero-sum game. There aren't many situations of positive sum or negative sum. Pretty much everything that we do, guys, is going to be zero-sum games. And essentially that means that whoever you're trading against, you better hope that they know less than you, and you better hope that they're not as good of a trader as you, because it's zero sum. What is the Nash equilibrium and dominant strategy when it comes to game theory? Well, Nash equilibrium in Polymarket, it's when prices reach a point wherein no player can get a higher payoff by switching to a different strategy. Essentially what this means is that all the people that want to buy yes have already done so and are not going to buy at a higher price. All the people that wanted to buy no have already done so and they're not going to do so at a higher price. What ends up happening, guys, when you get that? The market goes flat and you have reached the Nash equilibrium. Good example of that, let's say it's a market like a coin toss. If it's a coin toss market, the Nash equilibrium is just about going to be 50-50. It's pretty obvious because there's a 50% chance of both events happening. So there is no profitable deviation for you to make by buying at a higher price than the given odds of 50-50. Therefore, that is a Nash equilibrium. What is a dominant strategy? Because this is what we're going to be focusing on this course. A dominant strategy is when you can place orders that cannot be exploited in the long term. And that's what I'm going to be showing you guys throughout this course. Now, if you look down here, this is the famous prisoner's dilemma. And you probably already know the answer, but just to get you into the habit of it, if you see we have two options and we are prisoner one, we can confess or we can lie. What do you believe is the dominant strategy where no matter what we do, we're always making the best payout? the best option for us? Is it to confess or is it to lie? I'll give you guys about 10 seconds and then we'll go into it. So it's quite easy to solve this game. And I will walk you through it and we'll go over dominant strategy. So let us first not think about ourselves, but think about our opponent, prisoner 2. Imagine that prisoner 2 confesses. If he confesses, what do? Well, we have two options, guys. We can either confess as well and get 7 years in prison, or we can lie and get 10 years in prison, right? Now, if we're smart, we're probably going to want to confess, right? Now let's say the prisoner 2 ends up lying to benefit us. If we choose to confess, we don't serve any jail time. 0. But if we choose to lie, we get a year in prison. No matter what the other guy does, the better option for us to always do is to confess. That is a dominant strategy. Now let's get into strategic decision making. This is another part of game theory that isn't really so much the mathematical part, but more the psychological part. This is making moves based off of the expected behavior of others, and this is pretty much what you're going to be doing day to day as a Polymarket trader or a Kalshi trader. Here's a really good example that we can use to explain this topic. There's a market of will Nico Harrison of the Dallas Mavericks be fired? For those that don't know, he traded away Luka Doncic, the best player on the Mavericks, to the Lakers for pennies, essentially. Now, when the news came out, essentially a bunch of articles, tweets, social media were all calling for his firing. However, if you looked a little bit deeper, you would see that his firing was probably not going to happen anytime soon. And there's a pretty good play that you can make. If you believe that there's a 20% chance that he gets fired, it's pretty optimal for us to place no anywhere from 60 to 80%. This is a pretty dominant strategy. The only thing that would be bad about this strategy of us buying no, he will not be fired in this allotted time, would be if any news came out that he was fired or about to be fired, we would have to be very fast to react to that news. As long as news like that doesn't come out and the days stretch by, then this is pretty optimal for us to do. Now, this strategy right here is called selling the news. It's essentially buying a really cheap no event. So here's actually what it looked like, guys, in some trades. So the highest that it got to was a 38% chance. That's where traders were buying it at on February 8th when there was just a ton of buzz, which was, I think, 5 or 6 days after the trade. Now, 38% means that we can buy at 62. So therefore, if you had believed that there was a 20% chance that he would be actually fired, you would also say, well, there's so much buzz around the fact that he could be fired that I believe a lot of people are going to be buying yes at very inflated prices, such as 38%, right? So we could have bidded at 62%, maybe 68, maybe 72, anywhere around that. And really good news, only about 12 days later, if you can look at the market right there, it was trading at 95%. And I think a little bit higher, I think maybe 96%. So that would have been a pretty nice payout. Essentially, the whole strategy that you're doing here, game theory-wise, is anticipating what other people will do. You are anticipating that more people are going to buy, yes, he will be fired, not because of news, but because of how they feel. And that's how you make money with strategic decision-making. Now, this one is also another very common one, which is information asymmetry / signaling. It's a bit more advanced, and we will be covering it a lot later with news trading. But you should know on prediction markets, guys, some traders are going to have just better track records, better models, and they're going to have more information and or faster information. However, due to the public blockchain, people can see other people's results on these prediction markets. Other traders know. Other traders know when a trader is profitable and not. It's pretty obvious. You just click on their profile. So this can cause other traders to copy these smart money insider traders, which can create herding. Herding is essentially when, let's say a smart trader buys something at 50%, then the market starts heading up to 95%. Because so many other traders believe that some guy has insider knowledge and is a very smart trader, so everyone else buys the S as well. So one of two things tends to happen, guys, when there is a very smart trader or someone who trades quite large or just has a great model or a lot of information. It's going to create a price misalignment, or the lead trader, the guy that's smart and making these large bets, plus the lagging traders, i.e. the guys who copied him, acted on good information. So I know this sounds obvious, but only one of two things can be true. Either the price is misaligned and the odds shouldn't be that high, or the lead trader was right. And it's up to you to really uncover whether the information or, you know, how strong of a trader that guy really was who put a lot of money into it, okay? Becoming unexploitable. This is the overarching thing when it comes to all of this stuff. Essentially what I'm trying to get you to, if you want to become a very good Polymarket trader, you're going to want to become unexploitable. Now, Sun Tzu said, making no mistakes is what establishes the certainty of victory, for it means conquering an enemy that is already defeated. I love that quote. Essentially, we don't want to make mistakes, right? How do we do that? Well, we want to place limit orders that cannot be exploited. And when we do that, that is called GTO, or game theory optimal. So I'm going to give you a few examples, starting with this one. Here's a very exploitable example and something you should never, ever, ever do. Imagine that we place a limit order at 50%. Guys, what that means is if I want to buy 100 shares at 50%, I am risking $50 to make 50. And I'm doing it for the favorite to win a live hockey game. The current score of this hockey game is 3-3. It is the near end of the third period, and the current odds for this exact team to win are trading around 60%. This is a terrible idea for so many reasons. Let's talk a little bit about why this is such a bad idea, guys. I have a question for you. If we get filled at 50%, that means that someone has used a market order to execute on our trade at 50-50 when the odds are actually trading around 60-40. Do you think it's more likely that this is a dumb, large trader who just made a large trade and filled your order? Or do you think it's more likely that if you get filled, it's because the team you bet on already lost the game? It's going to be a lot more likely that if you get filled 10% away from the current equilibrium price, unfortunately for you, your team either just got scored on or has a significant disadvantage. Therefore, you doing this exact thing with a live sports game and putting a bid out 10% away is a horrible idea. The only way that this exact example would be okay is if you knew for a fact that there were a lot of very, very, very dumb traders on this market. That's the only way this would be okay, and even then. So I gave you the answer there. Now I want to ask you 3 questions. Now, I want you to read over these, guys, because it's very important that you find these, that you figure out the answer to this. Now, I'm going to give you a little bit of some hints. I want you to think about information signaling asymmetry and also strategic decision-making before we look at these and becoming unexploitable. Now, what you're going to answer for me, using all the topics that we've covered so far, is a yes or no question. Are these optimal plays? It's as simple as that. And there is a right or a wrong answer. So here are 3 examples, and I'm not going to read them out loud to you. I'm going to give you about 10 seconds to pause the video right here, right now. And if you don't pause it, we're going to go look at the answers, and you're going to be like, oh, of course that was the answer. So, yep, pause it now. All right, now that you have figured out your answers, let's go into the correct answers and the explanation. There you go. The first example, the answer is no. That would be a horrible idea. Terrible, terrible, terrible idea. Guys, placing a limit buy order for no at 10% if the market is trading 60-40 is a very bad idea. Now, if you're not already aware of Polymarket, don't be scared. Don't be like, this is too confusing. You got this. I want you to think about this with me. If a market is trading around 60%, 40%, and it's stable, but then out of nowhere, the market goes, like, let's say, to you from 60-40 to 90% chance of yes and a 10% chance of no, and you get filled. Is this a good situation? Absolutely not. Why? Well, why on earth would you get filled at 10% and it be a good situation? If you get filled, it's very, 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 very likely that this event, Israel attack Iran, has already happened. Your odds of winning this are very slim. Very, 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 very slim. So this would be a terrible play. This would be really bad because this is a news-based event. And if news comes out, credible news comes out that this event does happen, you're going to get filled. But let's talk about the counter side, guys. How probable is it that we get filled by dumb money, by the event actually not taking place? It's just not that likely. If a whale was to come in, you know, going from 40% to 10% is quite extreme. So this is probably not going to work out. Let's go to the second example. Placing a limit buy for no at 85%. For will Ethereum transaction fees average above $10 next week when market is trading around 90% no, 10% yes? This is very good. This is a pretty good idea most of the time. So for those that don't know a lot about Ethereum transaction fees, they don't typically spike that high to above 10 unless there is significant volatility or, you know, significant network usage, guys. So it's pretty likely that we can get filled at 85% just by some dumb money, maybe just by some luck, maybe just by a little bit of market fluctuation. And if we get filled at 85%, that's not a situation where you're guaranteed to lose. Not even close. Because the market's stable around 90-10, us putting a bid at 85 could very easily get filled by someone that doesn't know what they're doing or just wants to take a trade for whatever reason. This is good. This is definitely a good thing to do. The last thing I will say about this exact kind of play is that you have to be pretty good at blockchain analysis. You got to know what you're doing. And you should also have alerts out if, you know, transaction fees were getting to like $8 or $9 and they were approaching 10. Maybe let's get rid of our orders or sell our position. But besides that, this is a very good play. Now, the last one I don't think needs any explaining. You should know pretty much that's a very good play. It's a 50-50 chance. And here's what it would look like if you did the last play. Pretty good. If you do this, if you buy at 48%, you either make 52 on 100 shares. You either make $52 or lose 48. I did a Monte Carlo simulation of 10,000 coin flips with you, yes, you, buying at 48% on Polymarket with no fees. And this is what your money would look like. You would be up about $24,000. Actually, more than that, 24 like 800 or something like that. Why would you be up so much money? Well, you're up a lot of money because you're buying a 50-50 event, guys, at 48%. You know, and that's either a $52 win or $48 loss. That is very, very, very game theory optimal. So I hope that this presentation has given you guys some ideas for the future, just for the groundwork that we're doing with strategy and what it means to become unexploitable. Feel free to go over this lesson again. But don't worry, in the future, these topics are going to be fleshed out, a lot of them with real examples and more quizzes to make sure that you get very, very good at recognizing game theory and Polymarket. Happy trading. I'll see you guys in Module 4.